This is the Definitely Uncertain podcast, brought to you by Gold Rock Capital. Each week, we look at how high net worth families can improve their lives, decisions, and investments in a deeply uncertain world. We always aim to provide practical information, even if we can't offer specific investment advice.
Welcome to the Definitely Uncertain podcast by Gold Rock. My name is David Ram, and I'm a partner at Gold Rock, the more than 20-year-old multifamily office servicing high net worth investors in Israel and around the world. And with me today is Jashpal and Guillaume from Citi Investment Management. Jashpal is a senior portfolio manager, and Guillaume is the head of investment strategy for EMEA. Welcome.
Good afternoon.
Hi, David. Good to see you.
Good to see you guys. So today, what we wanted to talk about is some key economic trends that are happening in the markets, and then kind of discuss portfolio implementation, portfolio construction as a response to some of those macroeconomic trends and pictures that we're seeing happening around us. But perhaps to start off, maybe I'll ask each of you just to share with the audience a bit about yourself and what you guys are focused on nowadays. Maybe Jashpal, will start with you.
Thank you very much, David. Pleasure to be here. So I've been with Citi Investment Management now for over 23 years, having been in the industry for 26 years. And predominantly what I do within Citi is manage customized solutions for clients. And that's on a discretionary basis with fixed income, equities, alternative, but predominantly fixed income equities and mainly liquid assets from that perspective. And covering clients from around the world, predominantly. Gotcha. Guillaume?
As Jashpal suggested, we both have an extensive market experience. I mean, I've been with Citi for the last 12 years. The last 2 and a bit moved from the institutional business when I was running macro research for Citi into the private bank, where I am now responsible for strategy and economics for the broad Euro, UK, Middle East region. And I'm one of the voting members of our Global Investment Committee. And therefore, I am involved in making sure that we try and maximize clients' returns on a risk-adjusted basis for our discretionary portfolios.
Fantastic. So Guillaume, maybe I'll start with you a little bit about some macro aspects and what you're seeing out there, in particular around, if I could focus in on the consumer aspect. The consumer, typically in the Western economic world, is the majority driver of economic GDP, of economic growth. And today, it seems that the consumer, regarding spending, regarding wage growth, regarding aspects around inflation, it seems that it's relatively in a positive position, shockingly. We'd love to get your perspective on that and how that affects your outlook.
Yeah. I think the first thing to note is that consumers react very badly when inflation goes up. I mean, it's normal. It's an enormous shock to the system. Whatever you were budgeting for suddenly gets completely revised. So the fact that inflation pressures are now receding quite materially in the US and let's say across the P10 space is pretty good news. The last numbers that we've seen, I think, US focus in particular, were a bit disappointing into April. But yet you still see growth in excess of 2.5% to 3%. That's the sort of range over the past 12 months. So it's weakening, but it's not too dramatic. If we continue to anticipate inflation to moderate, which is, for us, US CPI around 2.5% by year end, probably core PCE a little bit lower than that, given the sort of mode of calculation, it means that we have a normalization of inflationary pressures, which should be a benefit. Now, when we turn to the income part of the consumer, it's been okay. It's been decelerating, but there's also the threat of an increasing tax burden if those US tax cuts don't get rolled over by the end of 2026. So when we put everything together, it's a softer picture for employment growth. It's probably a slightly softer picture for income. And it's only positive if you think that the total level of working population in the US continues to increase, which migration could help with. But there is going to be this interesting spanner in the works, perhaps with US presidential election. Now, the assessment currently is that the labor market is clearly cooling down. The numbers that we saw on Friday were quite interesting because it was another upside surprise in non-farm payrolls. And at the same time, it was a very disappointing reading for the household survey. And there's no two ways to reconcile it, really. It's one of them is wrong. And we suspect that the non-farm payroll number is going to be subject to significant revisions ex post, and that the underlying pace of job creation in the US is much slower than it used to be. So if we think about whether the US consumer could be the Achilles heel of the US economy, perhaps a bit more in the next few quarters as we see this labor market slow down. But we've been surprised by the resilience of the US consumer. So interest rates today are quite good for savers. And although the US has got few savers on aggregate, I still think that a large part of the population will also benefit a little bit from relatively high levels of interest rate from the Federal Reserve. So in a nutshell, the momentum is down. The level of consumer spending, I think, remains quite positive for now. But if there is one point of weakness in the US economy that we need to watch out more carefully, it is certainly that segment because of the size of GDP. As 2/3 of US expenditure comes from the consumer. So if these guys suddenly decide that the outlook is bad, then that's probably flashing more recessionary signals in the US.
And to the consumer spending point, it seems that a lot of the spending is coming from debt, meaning that we're watching the credit card expenditures increase quite substantially after the savings have actually been depleted over the past couple of years. So they're leveraging groceries, which is not exactly a good strategy. How is that going to affect? Because that's not so sustainable either. Seeing the same numbers in that sense, or are you seeing that as a negative?
Again, if we think that interest rates were to stay at those levels, then that's probably not sustainable. But how likely is the Fed to stay put at 5.25%, 5.5%, when both of the key indicators that they monitor and they have to react to, which is core PCE, more or less at target at the 2-year horizon, and the labor market continuing to slow, are starting to tell them you're too restrictive. So I think it's a timing issue now. They can still engineer soft landing. They've been quite lucky, I think, with the amount of tightening and the delayed economic reaction. But I don't think there's a reasonable scenario where rates stay high and we don't have something more problematic ahead of us.
And Jashpal, just in terms of the relationship between, I guess, equity investing and the consumer, is it much more around corporate earnings rather than the consumer? I mean, the consumer is much more of an economic headline, which may affect a lot of elements. But how do you think about aspects around the consumer, or are you much more focused around the earnings of the corporations?
I think it's predominantly around the earnings is first and foremost. But going back to the consumer aspect, this is why I think James Frazier, Citi's CEO, coined it the K-shaped recovery, or K-shaped consumer, where you've got the mid to high income earners. They're doing pretty well. And those are the continue to shop and continue to spend freely. It's the bottom half of that K, which is the problematic aspect of the US consumer, as you alluded to, buying groceries on credit and the challenges they have. Some of them probably got 2 jobs. So there is a challenge with looking at US consumers. But the mid to high income earners, as long as that job market remains resilient, then that should remain more buoyant. But just to add, if the earnings aren't there from a corporate standpoint, if they're not increasing margins or cutting back expenditure, that's more problematic from an equity share price perspective.
Gotcha.
Add to that on the earnings.
So in terms of just the equity element, one of the debates we often have at Goldrock, I'll just follow up on that point. It relates to the equity risk premium that often we try and calculate above the risk-free rate of return. So when the rates were 0, it was pretty easy. When the rates are 5, it's a little bit more complicated. And especially after a substantial uplift in equity valuations because of the runaway train that is the tech market, how do you think about the current positioning of a portfolio today where a client of yours could generate 5-6% in a pretty low risk, short duration income portfolio? And how do you think about the equity risk premium above that? How do you construct such portfolios in such a market, especially with all the potential headwinds that we just talked about with consumer and otherwise?
Yeah, first and foremost, Guillaume alluded to the fact that we don't see that risk-free rate staying at 5% in the near term.
Yeah.
And I think that's the important aspect is we do, see whether they cut interest rates this year or not. I think the destination is more important than the journey. So by the end of the year, and the market's 12 months forward-looking, you've got to ask yourself, where will the neutral rate of interest be? 3.5%, 4% is more alluded to today than 2% for sure by the end of 2025. So your risk-free rate going forward is a lot lower on treasuries and even other instruments within the corporate space, within the fixed income space. When you wash out the noise from a lot of the tech sector, the GameStops, the Spotifys, Shopifys, etc., you look at quality companies that have a decent earning, that continue to pay earnings on a regular basis and not just a one-off dividend, etc. So we look at quality investing from that standpoint within the equity world, and the tech space. Yes, that not everyone is spending so much on AI, but the companies that are you need to start seeing some earnings or some revenue on the back of those spending sooner or later. Because one could argue over the last 12 to 18 months, there's been about $1 trillion spent on AI-related investments, including the data centers, chips, semiconductors, etc. And that's going to continue. But sooner or later, the investor's going to want a return on that.
A real cash return, not just an uplift in the valuation. So Guillaume, when you think about corporate earnings today, we were looking at, just as an example, we were looking at the broader S&P 500, where you have those top 5, 10 companies, and then you have the remaining 490 or so companies, and there's a big dispersion today in the price earnings ratio, perhaps even earnings quality. When you guys think about the future in terms of corporate earnings and the ability for the corporations to pass on significant profits to their own customers, how do you think about that moving forward in a economic environment that we're involved in today?
I think it's going to be harder and harder for the corporate sector to repeat the success they've had in the past. I mean, just take the example, because they came out on Friday in Europe. We saw compensation for employee, which is all remuneration that you get from wages and one-offs, etc. But also the PC deflator, and therefore the sort of profit margins. Profit margins are no longer expanding on a macroeconomic basis as of the first quarter of 2024. 12 months rolling. So it's telling you that inflationary pressures are coming down, and it's much easier for the corporate sector to protect their profit margins when prices are increasing quite fast and when there is meaningful inflation. When you are in the situation where suddenly, to protect your margin, you have to continue passing on more, that becomes more difficult in the present environment, where there is also obvious disinflation coming through the commodity prices. So for corporates to continue expanding margins, they have to push up prices in an environment where many households are already squeezed. Yeah. And what I suspect many of them will do is that they will internalize a little bit more of future price increases they see either in terms of commodities and or wages, and try to protect the quantity element of their strategy. So because we live in a middle world, if it's P times Q, price times quantities, if you can't move on P, then you have to shift Q. And I suspect that we're going to see perhaps a little bit of a slowdown, certainly in real terms, of what corporates can do. But you don't need an awful lot of top line to still see a bit of margin expansion going forward. So it's an interesting, we're at the pivot, I think, for the corporate sector, where more interestingly, globally, we see a broadening of earnings performance across sectors, but also across regions. And that's the reason why, a lot of concentration in some of the top names of the S&P 500 perhaps doesn't make that much sense from a medium-term investment perspective. It's better to look at cheaper, more diversified, still quality other equities that are available for us to put in portfolios.
That's interesting. And another aspect around that is, they're often levered, these companies, in order to help with their expansion, in order then to get recouped through profits to service their own debt. You guys mentioned that your perspective in the near term is that rates will likely go down. I'm not sure what near term means. We can talk about what near term means specifically from your perspective. But we always say at Goldrock that we have predicted 18 of the last 3 recessions. We're always a bit bearish, unfortunately, in terms of portfolio construction. And we were actually really expecting to see some kind of a distress cycle, which relates more to the debt when you have higher rates and the ability to support that. And then you have the requirement to refinance, et cetera. It hasn't happened. It doesn't seem like it's going to happen. You guys are predicting rates going down in the near term. How do you see the health of the fixed income side of the journal?
It's interesting, David, because we get this question a number of times. Because typically by now you should have had a recession.
Yep.
Given the indicators of the yield curve and the inversion of the yield curve, given all the other indicators, but we haven't for a number of reasons. And I think predominantly you've got to look at the health of the corporate balance sheet, as you've alluded to earlier on. It remains very healthy on the corporate side of things. Mm-hmm. We've had a flood. I think it's the third year of largest record issuance in the past 20, 30 years. And the previous record issuance was just after the financial crisis, around 2013, and also around 2016, 2017, when rates were pretty much zero from that perspective. But the interest margin is a crucial aspect here. And corporates have been able to come to the market. They're able to service their debt and prolong, i.e. push out the maturity wall. And that's what's kept investment-grade corporate bonds doing very well. And also the huge amount of cash sitting out there, which is over $6 trillion at the moment, David. And we don't believe that's going to come down dramatically in the next 3 to 6 months, and let alone 12 months. Investors are looking for quality corporates. The corporate index today is around 50% triple B. So a lot of corporates have kind of increased their debt. It's been favorable for them to increase their debt because pre-08, triple Bs were, 10, 15%, if not 20%. But you've now had a tripling of
20% of the share of the investment grade
of the index, correct?
Mm-hmm.
So you've had a huge pickup. But high yields tripled in size, investment grade tripled in size, private credit is tripled in size. Everything is tripled in size within the fixed income world. But there continues to be a huge buyer for these corporates from that perspective. And as long as they continue to service that debt, fundamentals remain intact. We don't see an issue with investment grade. And in fact, you can get 5.5% to 6% yield on that as well in the intermediate part of the curve, which is what we like.
Yeah, it's quite astounding. So, and especially if you think rates are going to come down, their ability to service that debt and get it refinanced as well increases. If I could just take a quick detour for a second to another area that have been spending quite a bit of time on at Goldrock in terms of portfolio construction, relates to gold, commodities, things like that, where when you're worried about recession, when you're worried about even perhaps geopolitics, a lot of times hard assets can be an interesting place to go. So Guillaume, I wanted to ask you just around gold. I see in the background of Jashpal's screen, he's got something running in TV. Bloomberg is running on TV. Those guys, all their ads are crypto.com or whatever it is. So they don't talk about gold. They just talk about crypto all day long. Oh, there it is. Crypto.com. There it is. So, but gold has had a pretty nice run over the past 12 months or so, and it's a bit counterintuitive with rates high because obviously it's a negative carry trade where it costs money to store gold. You don't actually generate a yield holding gold. It's true with other commodities as well. But yet it's had a pretty strong run. There's been a lot of talk around copper, other elements that perhaps can be parts of a portfolio construction. Of course, I don't want to talk about it too much in detail, but digital assets like crypto, which now have ETFs that allow guys like yourself to advise clients to buy these things in much easier fashion. How do you think about these elements, which are, there's no corporate earnings, there's no issues around consumer spending, perhaps, I'm not sure, maybe there is, but how do you think about those elements as a store of value or just as an input into something else? How do you think about that in a portfolio construction format?
So when we're having discussions about gold within our sort of global investment committee space, it's really essentially about whether there's going to be use for the commodity itself as a diversifier or as a hedge. But to go back historically to see meaningful portfolio allocation to gold commodities, I can't remember that far back, nor do I think that the framework would allow us to do an awful lot. When you look at sort of the returns of the commodity asset class per decade since the 1970s, one decade is high, one decade is low, and if you were to look at years within the space, you can see extreme valuations and volatility. So why would you think that you can peer into the crystal ball better than the others and think that it's going to work for you? Now, on a very short-term tactical basis, if we align with our colleagues at Citi Research, then perhaps we can talk about some of these things going forward. But that's what we did almost for copper miners in particular at the end of last year when we looked at Outlook 2024. But we didn't put it in the portfolios because it's a bit too narrow. But we left it on the list of possible opportunities, and it's done extremely well. So well, in fact, that we've taken it off the list of opportunities. But when I think at gold from a macro stance, we want to look at gold in real terms, inflation adjusted, and gold is now at a record high in terms of inflation adjusted prices. And that makes me a little bit circumspect about having a trade or a position on that, unless you think that there is something fundamentally wrong with the global economy, which is something that we, for now, disagree with. So why
is it then? Why is it record high? What is the?
I think it's just a lot of central bank demand that also plays in terms of reserve management, and who can read in the minds of most central bankers at any point in time. There's also the fact that geopolitics is perhaps a little bit higher on the list of concerns. I mean, if you take the example of the Central Bank of Russia, obviously there was something being planned for the Ukraine event, and they've played the blinder with what they did with the gold stock because you can't sanction gold.
Yeah.
But otherwise, it's probably a little bit too volatile for portfolio purposes. It's a store of value, yes. It's a means of payment, absolutely. And having a sliver of it in a portfolio won't do any harm, but I don't think that you can really go large overweights for underweight in something which is just too volatile for us.
Fair enough. And Josh, please, you go ahead.
Yeah, I was going to say, you've also got to argue, people have been wanting, since I've been in the industry, a dollar debasement. It's not going to happen. I think in a asset allocation, the dollar was normally about 70% for central banks. Now it's around 55% of central banks' reserves. And this has recently picked up, as you allude to, over the last 2 to 3 years since the Russia-Ukraine war. And so the world we're in today, which is multipolar, i.e., which back in the 80s you never had the Saudis or the Middle East doing so well and having such cash. Other parts of Asia doing very well with so much cash that they're looking to diversify away their current dollar allocation. But it's going to take a hell of a long time for that to decrease from 55 down to 40, 45, but will still stay quite elevated. So central banks' gold allocation's gone from something like 9% to around 12. It'll keep going up to probably around 15, but I can't see being dramatically too high, and that will take another 5-10 years as well from here on in. So it's a long-term move what central banks are making, but it's not going to make a huge shift, we don't think, given the rationale you've just mentioned there, Guillaume, as well.
So that's a good segue as well to the geopolitics story, which obviously is quite an elephant in the room in terms of an investment, in terms of portfolio construction nowadays. So we have a couple of wars going on, Ukraine, Israel, potential for them expanding. We have an enormous amount of elections going on across the world. I think you guys just had one in the EU yesterday or whatever it was. So that was pretty interesting. Got one coming up in the US, which is taking up most of the time on the 24/7 news feed. So how are all those elements affecting your portfolio construction nowadays? and your thinking around investment and, of course, risk management, because obviously some of those elements are binary in outcome. So how do you guys think about that in terms of how you construct portfolios?
So let me just frame the discussion we're having about geopolitical risk generally. When we look back historically, it's really rare to find a geopolitical event which will change the course of the global economy for more than a couple of weeks. You need to go big, i.e. you need to go World War II, you need to go oil embargo of the 1970s, etc. If you think more recently about Russia-Ukraine, this should have been one of the major moments because it was impacting everything in terms of energy, in terms of a lot of industrial supply chains. And what happened is that businesses show flexibility, policy tends to intercept quite a lot of downside risks, and the world then refocuses fairly quickly on, I think, a path of least resistance, of course, as soon as supply dynamics starts to shift a little bit. And in most cases, when the price signal is strong enough, then demand adjusts. So it's really rare to find that particular geopolitical risk materializing, which is a low probability event, but massive market impact, to then change the course of asset allocation. So we tend to be a little bit more agnostic on that. And you can't build a portfolio for everything, but you need to be relatively robust in the asset allocation that you do and in the regional diversification that you use to try and stay invested through the cycle. So what we are trying to overlay, which we did at the end of last year, is sort of thematic on economic security risk management. That has been alongside the lines of duplication of energy supply chains, so Western energy producers, in particular in terms of oil, has worked quite well. Defense deterrence in terms of a lot of aeronautical firms, defense spending, a lot of critical commodities, I think, but also sort of geopolitical realignments alongside the friendshoring, the countries you can do business with. So you can still stay invested while having this lens of economic security running through the portfolio and effectively mitigating the risks that you can't obviously anticipate fully, nor do you want to do dramatic shifts in asset allocation. If you're worried about the short term, I think it's quite possible, then there's some cheap downside protection you can overlay to portfolios. But geopolitical risk itself, right, I don't think that you can stay out of the markets on the premise of something potentially happening later.
Understood. So not much in the move of you're not really moving the portfolios too much. Yeah, Jashpal, you were going to add.
I was going to allude to the fact as well. This is the other rationale why investors will always be buying US treasuries. The safety is always going to be there because the geopolitical risk comes and goes pretty much every 3 to 5 years. There's always tensions in some form or another. We've been talking about China, Taiwan for a number of years. Whether it happens or not, we don't believe it will. But whether or not, it's something that on people's mind. Yeah. Investors ask this question time and time again when it comes to China or Southeast Asia from that perspective.
Yeah. China is always an interesting topic, which is, whether it's an investable country or not, just because of what happened, I guess, a couple of years ago when basically one man changed policy on a number of specific sectors, and just the equity markets got crushed as a response. It was very difficult to mitigate or manage that risk if one guy can just say, education is now for-profit education is illegal. Okay, well that's it. That market's done. So it's kind of a difficult market to invest in. I'm not sure if you guys have exposure typically for clients in the Chinese market nowadays. After that,
I would just add before we answer that question. I would just add. Yeah. I think there's a lot of things Xi Jinping alluded to, and some people, from a social standpoint, i.e., limiting computer gaming. You ask any parent, they would love that for their children to be limited on the gaming in the Western world. So one could argue, but that wouldn't be too bad. But I don't think it was these aspects that tipped the market. I think what tipped the market was the property sector, and that's 25% of the Chinese market today, 25% of GDP.
Yes,
David, that becomes a challenge when you're not fixing that property sector. And so he turned around and said, a property is to live in, not for investment purposes. And once again, I'm sure someone trying to jump on the property market in the UK or the US is probably thinking, actually, yeah, true. Why can't we do the same? But we won't do the same. So, but the challenge is not fixing the property market's challenges and that spiral effect has caused a challenge with China from that perspective. But we do have a bit of China in the portfolio. We're currently neutral as a global investment committee, which I'll let Guillaume allude to more, in fact. But it's become more of a trading position now rather than a longer term position, because, like you said, there are challenges longer term with China. They're the ones being buying gold. They're the major buyers of gold. And look, once again, on Friday, he turned around and said, stop buying gold. Maybe you'll see gold price come down again. But generally speaking, it is a challenge. But the tech sector there is a lot more attractive, I would say. Guillaume, I don't know if you want to add to that.
Generally, right, the opportunity was here for us to go underweight China earlier this year, and we decided to go neutral. Now that the markets has repriced quite a lot, it's painting a fairly gloomy scenario around it. There are some small hopes of a little market turnaround in the short term. It's going to take a long, long time to solve a property crisis. It normally requires bank recaps. If it's a private sector bank, it's a big issue. If it's a public sector bank, there's long duration in the process. But I think what the Chinese economy looks like now is outperforming very slightly, despite the sort of reservations you might have about the numbers. And an economy that's reaccelerating while the property market is still in the doldrums, I think is quite interesting from a sort of valuation standpoint. Maybe we've seen the worst of the correction. Can you not be exposed at all to China, world's second biggest, largest economy, on a 12 to 24 months basis for global portfolios? I'd say probably not. It's not that it's not investable. I think it's just, again, it's a diversification play. You can't have one part of the economy doing very well forever and the rest of the world economy doing not so bad and still see valuations which are so depressed. So I think it's really sometimes a bit of a tactical, but also long-term thinking about, if the policy tools have been activated, the levels have been pulled, and the economy is starting to perform a little bit more, then why not a sliver of optimism or less pessimism, let's say, on it's still, second world's largest economy, generating 5+% GDP growth. So it's meaningful.
Absolutely.
And compare that to the rest of the world, where you're just about getting 1% to 2% growth. 5% is good. The other challenge, what we've not touched on there, is they're on the cusp of deflation. They need a lot more from a central bank perspective, where every other central bank around the world is fighting inflation rather than deflation.
Interesting. And there's also another debate that we often have at Gold Rock internally, and then, of course, with our clients as well, which is often an interesting conversation, which relates to global asset allocation. Investing across the world, China included, but otherwise, Europe, having a global asset allocation as opposed to maybe a more U.S.-centric or U.S. even only asset allocation. The thinking, of course, is diversification should improve risk metrics, and if you can generate a similar return to the equity markets with some more diversification inside of it, you've done a good job. Over the past 15 years, it's been a challenge. And obviously, if you look before the GFC of 2008, probably for a good 30, 40 years or so, global asset allocation was a great idea. For the past 15 years, the S&P essentially doubled the returns of a typical global asset allocation, more or less. So I'd love to get your perspective on, has the past 15 years affected that attitude at Citi, your personal attitudes toward global asset allocation, how you think about it, and is the U.S., should the U.S. be a much more central part, more than perhaps what's normal, in order to ensure that you can actually deliver an outsized return for your clients? How do you guys think about that?
There's one particular aspect, I think, which is not keeping us awake at night, but when we look at the disconnect now between the share of US equities as a percentage of total market cap, which is in the high 60%, and when you look at the share of US company earnings as a share of global earnings, and you have that almost 20 percentage point gap, it just doesn't seem right. It just tells us that US equities are very expensive. They are expensive for a number of obvious reasons. But can we expect those to continue staying expensive almost forever? And I think the short answer to this is no, because the world is cyclical. So once you reach the point of some extreme valuations or extreme disconnect between two series that should be fundamentally extremely correlated, but also almost level pegged, here comes the decision that we made in May to add a little bit more to Asia and Europe, to move 3% overweight global equities.
As a consequence of U.S. exposure?
By taking down and reducing a little bit of the overweight we had to U.S. equities, which we still maintain because they're still about 3.5%, but it's targeted towards cheaper parts of the U.S. equity market, for instance, S&P 400, mid cap, S&P 600, small cap, growth names. And where we look at the S&P as a whole for large cap, we're now neutral because we're slightly overweight the equal weight, but we're slightly underweight the large cap one. So we try to find the right rationale to get exposure to what is a cyclical rebound in the global economy. And given the position in the cycle in terms of economic surprises in the US versus Europe and Asia, it makes more sense to increase allocation very slightly towards the ones inflecting upwards, i.e. non-US, and reduce exposure from the ones which are effectively slowing, which is the US economy. So it's not a very big call. It's just a logical call based on valuations and historical patterns. And it's the direction of travel towards broadly diversified portfolio, because this is a market that's going to be broadening out, not narrowing.
Interesting. Yeah. And Jashpal, in terms of your portfolio construction as well, when you think about, especially when you interact with clients, because I can only imagine you're probably getting the similar frustrating calls that I often have to manage. What's the communication on your side when you talk to clients about U.S. versus non-U.S. exposure?
For sure, it is a challenge, especially when the US is doing so well from that perspective. But we also have to allude to the fact that a lot of the companies we choose in selecting our stock, like Apple, where do their revenues come from? These are US companies, we agree. And vice versa, some of the European companies that we pick in portfolios are global companies. They're all global companies. So their revenue stream is not just in Europe. But one of the benefits this year that I have to allude to is finally Japan is doing something after decades of being asleep, I should say. So that's been a good conversation with clients. Right. Unfortunately, from a dollar perspective, it's not as good, but we are starting to see the benefits of having some Japan in portfolios, even though it's a small allocation, whereas historically it's just been kind of more noise.
Right. It's finally working. It's finally working a little bit. So in conclusion, this has been a great conversation. I'd love maybe, if you don't mind, if each of you can just give one maybe practical idea for a change to a portfolio, or a thing that you guys have added recently to a portfolio. I'll even let you say, Ethereum. You can even use that as your example if you really want to throw in another ad for the crypto market as a joke. But yeah, I'd love to hear one idea from each of you about what you're thinking about for the next 6 to 12 months for a good add to a portfolio. Josh.
Sorry.
Go ahead.
I was going to say I'm going to cheat because I'm going to look back at what we did for mid-year for 2024 outlook, and we had a list of 11 tactical opportunities that we couldn't really crowbar into the main portfolios, but we thought would make sense. There's only one that lost money in the first 5 months of this year. It's long the Japanese yen. I think this is still a good idea if we think that the world is improving, and that eventually, as central banks normalize their reaction to an inflation picture, which is normalizing, should see, I think, some benefits. In particular, if you think that there is this sort of shareholder reset that's happening in North Asia, in an economy that's probably now coming out and experiencing a bit of inflation, I think eventually the Japanese yen will be one of these currencies that will attract more international investor interest. And I think we'll be going more in the direction of a little bit more risk on through non-US equities as we go into the second half of this year and into 2025.
That's very interesting.
Yeah, I would add to that. I'd be still advocating more equities in portfolios. I'd be more overweight than what we're currently around 3% in a balanced portfolio. Overweight equities, I'd be slightly higher given a choice, given the situation, given the fact that whether or not the Fed does move or not, equities still have further room to run. I personally believe a bias to a US as well, unfortunately, contrary to the house view.
Fair enough. Sounds good. Well, guys, I really appreciate your time. This has been really, really interesting, good conversation, and your insights have been very valuable. So keep it up, and let's stay in touch. And thanks all for listening to this episode of the Definitely Uncertain podcast. And I'll see you next time.
Thank you, David.
Bye-bye.